Well, as you say, it's a market of real strength in FIC and notably the macro products. So rates and FX performed outstandingly, also emerging markets. And our financing business was also strong and has been throughout the year. That's been offset by credit markets and also the origination advisory businesses. There, the wallet, depending on the product, is down 40, 50, 60%. And of course, we're traveling with that market environment. In our case, we book leveraged debt capital markets loan commitment markdowns in the business. Some of our peers book it elsewhere. And so adjusted for that, we're down 63%, a weak quarter, but in line with the business mix that we have in origination and advisory.
And I see the private bank is also doing quite well year on year, net inflows of 8 billion to speak about. But what have clients been doing in that space? Have they been trading less given the environment?
Well, we're very pleased with the inflow numbers, as you say. So what we call new business volume, so loans and assets under management in the year to date are up 36 billion euros, which has been strong throughout the year and sort of surprising given the market environment and the uncertainty that investors have. There's certainly been areas where our private investors and wealth investors have pulled back this year. And that's been most evident in Asia, but there's been uncertainty for investors across the board. That said, they've reallocated, and we've had a suite of products that have enabled us to support the clients as they've made their investment decisions in this environment.
I see you're keeping your target of return on tangible equity of more than 10% by 2025. So we've spoken about your private bank, we've spoken about your investment banking business. Are those going to be the two drivers to help you get there to that 10% mark?
Well, what we laid out to investors in March was a combination of underlying growth in the businesses supported by interest rates and then execution of our strategies around tight resource management, especially expenses in the company. We think all of those things deliver the 10% ROTE or better in 2025. And although the environment, of course, has changed pretty dramatically since we started planning for that future, our assessment at the moment is that's entirely, we're on track for that, and we'll be able to navigate this uncertain environment through to 2025. So no changes in our strategy or the goals we've set.
Okay, on track. What about on costs? Because you're also guiding to a cost-income ratio towards the low 60s, whereas historically the cost-income has been quite sticky around 70s. How are you going to get there? And can you get there in an environment that is so inflationary for costs?
Sure. A lot of work to do on costs, for sure. And the environment, again, there changed with inflation. That said, we've had a number of significant projects, initiatives underway. Again, that we shared with investors to take about 2 billion of costs out of the company. Those initiatives are, as I say, well in train. We have a lot of focus and discipline around the execution, so we're confident we can take that out.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.